Hey, what's up everybody? Welcome back to Creator Crypto. So with all the recent price action, I wanted to do a quick video talking about some of the unique characteristics of the Bitcoin network. Specifically, I wanted to try and reconcile how it could be true that the illiquid supply of Bitcoin is constantly going up over time, meaning the available supply of Bitcoin to be purchased is going down, yet at the same time we're also seeing the price drop so precipitously. Basic supply and demand would suggest that we should fairly consistently be seeing the price move up and to the right without these drastic price movements. For starters, under the current system, the macroeconomic backdrop is completely subject to the US Federal Reserve. And recently, they've started signaling a more proactive and aggressive approach to rolling back recent easy money policies. Now, the market didn't expect the Fed to be this aggressive, so those risk-on assets that have benefited from the easy money policies have been hit hard this week, and that's hit growth stocks, tech stocks, and cryptocurrencies alike. Still, it seems like given the cap supply, Bitcoin's price really shouldn't be able to move this violently still. To illustrate how Bitcoin is a little bit unique, it's helpful to think about the Bitcoin market as two camps. On the one side, we have speculative traders. These are investors who are looking to leverage the volatility of Bitcoin and turn it into a big payday. They're willing to sell at the first sign of trouble. The important thing to know about these traders is that they frequently use leverage on the derivatives markets. What this means is that they're borrowing money and then putting up Bitcoin as collateral so that they can increase their exposure and increase their possible payday. Of course, in the event of a margin call, this Bitcoin is dumped onto the market in an automated fashion. This causes the price to fall, and then other traders who hold similar positions, this triggers margin calls for those borrowers as well, and their collateral is in turn dumped onto the market as well. This is what's known as a cascading liquidation, and it's the reason behind some of the really violent moves that you see in Bitcoin sometimes. The last point to make about these investors is that they're looking to become wealthy as denominated in US dollars. This is a profound distinction from the next group we're about to talk about. Now, in his recent testimony before Congress, Brian Brooks, the CEO of the Bitfury Group, explained how these traders can have such an outsized impact on the price of Bitcoin.
A lot of the price volatility of cryptocurrency has to do with the early stage of the market and the thinly traded nature of the asset compared to, for example, U.S. real estate, global equities, or anything like that. I think the message I'd land with this committee in response to your question, however, is some of the things that make U.S. equity and debt markets more stable and less volatile have to do with the fact that there's a lot more price discovery in those areas. And what I mean by that is, in the U.S., we have regulated equity mutual funds. We have derivatives products and futures products that allow the free trading on a 24/7 basis that provides the market with forecasts of what's happening in the ecosystem. In the world of crypto, the U.S. hasn't responded by developing those tools for price discovery yet. And so the result in a relatively new, relatively thinly traded market is that one person unwinding their position can have a massive effect on the price.
Now, in the second group, we have HODLers. These are the true believers, and they don't sell for anything. The price can 10x, they won't sell. The value can drop by 80%. They still don't sell. It's often said that HODLers set the floor. When the price drops low enough, these are the people that swoop in, they move in aggressively, and they scoop up all the available Bitcoin. They take it off exchanges and then put it into cold storage where it's never to be heard from again. This is how the illiquid supply keeps going up over time. This group of people is why Bitcoin will never go to zero. They're smaller investors and they move in smaller increments and they don't use leverage. They just want to own the asset. Most importantly, they're looking to become wealthy as denominated in Bitcoin. Stacking sats, as the kids say. It's important to understand the psychology here because it's unique to Bitcoin. The elevated US dollar valuations don't tempt them because they're trying to escape the legacy fiat currencies and they see Bitcoin as the escape hatch. Immediately after Brian Brooks' previous statements that we just saw, he goes on to explain the commitment of Bitcoin hodlers.
Last point I would just make very quickly is something like 80% of Bitcoin holders have never sold a Bitcoin. And so when you hear about a day when there was a giant price drop in Bitcoin, often it turns out that there was one or two large traders who were unwinding a leveraged position, and the vast majority of holders have enough confidence in it that they've literally never sold a unit of it. So I would argue we need more liquidity and more price discovery to tamp down volatility, not less.
There is an army of true believers, and they're committed to seeing Bitcoin succeed. So the tug and pull between these two groups can make your head spin if you're new to the space and don't quite have a feel for the maturity of the Bitcoin network. The net result, though, is a reduced supply of available Bitcoin. And this is why when demand inevitably returns, the price moves so violently upward, because there's not much left to be had. This is why I'm confident in the continued adoption of the Bitcoin network. That's it for today, everybody. Until next time, cheers.